It's never been a better time for OT security. Now, before we get into why, can I see a quick show of hands? Any founders or would-be founders in the room? Nice. Thanks for coming. Any employees of startups or consultants or people who work with startups? Yeah? Okay, great. Anybody who sees their logo on the slides behind me here, any asset owners, utilities, industrials, customers of startups? Well, thank you. I think I have something in this for each one of those audiences. But you probably want me to justify why it's never been a better time for OT security than right now. And there are three reasons, really. The first is it's a massive market. These companies that are buying these OT security products, some of the biggest companies in the world, they have huge budgets, and they're finally starting to take cybersecurity as seriously as other sectors who've long spent substantial portions of their budget on security. The second is we have proven success. So we know it's possible to make a lot of money in OT security. Dragos is a Energy Impact Partners portfolio company. It's worth $1.7 billion today, and people know that there's a lot of opportunity here. So it's been proven it can be done. And the third reason, which is related to this success and proof that it can be done, is that there's access to capital. So in 2021, more than $1 billion of venture capital went into OT security. 2022, the market took a little bit of a dip, but OT security has stayed strong, and cybersecurity in general has stayed strong. So it's a great time to be in this space. You're all positioned really well, and we're here to help. Energy Impact Partners, the team behind me, this is our cyber team. We're a $3 billion venture capital fund backed by 60+ utilities and industrial companies. So if you take one thing away from this talk and nothing else, take away that you should go big. Everything else in this talk is really just the why it matters to go big and some tips and tricks on how you can go big. But venture capital and startups are all about going really big. I love talking to a room like this because I come from a cybersecurity background and because everyone in this room inherently understands risk. You all know that equation, impact times probability equals the risk. So when I think about this, I go back to one of my favorite games growing up, Dungeons and Dragons. And I think about the knowable and the unknowable. The outcomes are knowable. It's like the Dungeon Master, right? They have all the options. They've already prepared everything. Similarly, in cybersecurity, we know the worst case scenario. We've mapped everything out, and we understand what we can actually predict will happen versus the things that are unpredictable. Okay, so go big. If you don't remember anything else, remember this one slide. I think about the game Dungeons and Dragons, and you think about the outcomes that are knowable, and we think about the probabilities, which are also knowable. You might not know how the dice turn up when they get rolled, but you know the range in which the outcomes are distributed. Just the same in cybersecurity. 0 days are the rare exception. We basically know when things are vulnerable, or at least it's possible to know when things are vulnerable. You may not always know exactly, but these are knowable things. By contrast, startups are managing uncertainty. So a founder's job is pretty different in a lot of key ways. You don't know the size of the outcome you're going to have, right? A company like Google can be founded with a few $100,000 or a couple million of venture capital and grow to be tens of billions of dollars. You also don't know the probability of that outcome, right? So we have some rough heuristics. We can look at historical stuff, but it's fundamentally unknowable. There's as many ways to succeed in cybersecurity startups as there are people. So this is a little more like poker. The odds are in the cards, but you're not playing the cards. You're playing the person across the table from you, and you don't know what's going on in their head, whether they're bluffing or not, what the propensity to bet is. And you don't know the upside. If you're playing against a billionaire, you might take all their chips, and they might throw down the keys to their yacht, and you could get really lucky. So when I put this on a spectrum, you can see risk management on one end and uncertainty management on the other end. In finance, it looks like insurance and fixed income, which are bonds on one end, and private equity and venture capital on the far end. In cybersecurity, we live over on the risk management side of things. There are really only 4 things you can do in risk management. You can avoid, you can accept the risk, you can mitigate the risk, which is where we spend most of our day, and you can transfer, which is kind of controversial. People have a lot of opinions about cybersecurity insurance, but there are other ways to transfer too, whether it's outsourcing to a managed security service provider. But again, most of the focus is on mitigation. In uncertainty management, there are 4 tools, but only one of them overlaps, and that's avoid. And just like in cybersecurity, that decision is usually made upstream. The business has already decided to take the risk. It's our job to deal with it. In venture capital, the investors, these large corporates that want us to invest their money into cybersecurity startups on their behalf, have decided to take a very small % of their balance sheet and put it towards venture capital to make some smart bets. But that decision has already been made by the time it gets to us. You can also hedge your risk. That's more the business of hedge funds. It's making opposing bets that balance each other out. So you might sell treasury bonds and buy US dollars if you don't want to take the interest rate risk, but you want exposure to the US dollar. It's not really what venture capital is all about. What we do is diversification. So we have a portfolio. We would like to make more bets, but there are only so many good cybersecurity startups that you can bet on. It's not like buying an S&P 500 index fund where you own the 500 biggest companies in America. There may be a dozen or so. We have 13 in our portfolio right now. We've exited 1. So in a little less than 10 years, we've made 14 cybersecurity bets. We'd like to do more. The main thing we do is we stage our bets. So what does that look like? Well, before we get into staging, let's discuss why it's important. First, you want to distribute your bets throughout time. So you want to take your poker chips and you want to buy that ticket to the next round, which will let you know if you should make further investments in the following rounds. Second, you have to get information from that poker chip, right? You have to turn over the next card. In other industries, oil and gas, this looks like exploration, whether you are going to invest more in drilling because you know that oil is there. In entertainment, it's like a TV pilot. You want to run the show and see what the test audience thinks before you commit to a whole season. In pharmaceuticals, it's a clinical trial, same thing. And then fundamentally, the third part has to be there. You have to be able to walk away if it doesn't actually go the way that you thought it would. So in poker, that's folding your hand. In entertainment, you cancel the season. Oil and gas, you pick up the rig and move somewhere else, more fruitful. In cybersecurity investing, that's called a down round. So you might have invested in a bunch of rounds of a company before, and then you reprice the company. What does this look like in practice? Well, here's kind of a toy example. Any real finance pros will know that this is a huge simplification. We don't deal with the ideas like time value of money, which is $1 today is worth more than a promise of $1 tomorrow. We're not really looking at dilution. We're assuming that you're going to own 20 to 25% of the company when you sell it. But in principle, this is how it works. You could either, like at the top, make one lump sum investment, let's say $44 million, for the opportunity to make $375 million. There's a less than 10% chance that that's going to happen. You run that experiment 10 times, and you lose money. It's not a good deal, right? But venture capital stages the bets. So we're only going to bet $2 million in the seed round for a company that we believe is worth $5 million. And we think there's a 30% chance that it could be worth $30 million. Then we'll invest a little bit more. If we think that it's going to hit the next milestone, we'll invest more. And then pretty soon, you're at that $375 million exit on a $1.5 billion company. But crucially, at each of these stages, you have the opportunity to walk away. So if companies don't hit their milestones, you're not throwing good money after bad. So what goes through the mind of a venture capitalist? That was a one-company example. Let's look at a 10-company portfolio. So maybe we'll make 4 investments in the very first year. We have a 10-year fund. That's usually what the investors in venture capital expect, to get their money back in 10 years. They'll want to see a few investments in that very first year so that you have something coming right out the gate. But you can only make new investments for a few years because you have to give the companies time to grow, and then you have to sell them before you return capital to your investors. So your investment period is really in years let's call it 0 to 4. And your investors are going to expect you to not only return that capital, but to probably double or triple it, because you're holding their money for 10 years. It's a long time. They could have done something else with that money. And you're taking a substantial amount of risk. That means in year 2, for example, you might make 3 more new investments. In the 4 that you made before, you'll only follow on with 2. In year 6, or excuse me, in year 4, you'll make your last 3 investments, and you'll follow on with another Series A, and maybe those 2 Series A companies are now Series B. But you're done making new investments because these companies need time to grow, and you want to double down on your winners. By the time you get into years 6 and 8, you have very few winners left. You're pouring all of your capital into helping those ones grow. And then by year 10, if you do it right, you have at least one that can IPO or get bought for a large acquisition. So the way this breaks down is, you have 6 companies that will fail. And by fail, I don't mean go to 0. I mean, you get your money back. But if I told you could lend me money for 10 years and I paid it back to you with 0% interest, you would not be very happy with me. Then you have 3 companies where maybe you'll do as well as the market, right? You'll grow a bit, you'll sell them, it won't be a catastrophe, but it caused you a lot of pain and a lot of stress and a lot of work when you could have just bought some bonds or bought some stocks 10 years ago and not looked at it. And then you have one that's going to go really well and will return the whole fund. So that's when it works, crazy as it is. Okay, so what are my 5 reasons that OT security investors don't invest in a startup? 1, back to the main point, the idea isn't big enough. It's got to be big. 2, the product doesn't scale quickly. 3, there are no milestones or product roadmap for venture capitalists to follow so that we know the staged investments. 4, no traction with customers or team credibility. Now this one's really hard because a lot of early stage companies, of course, aren't going to have a long roster of customers. But there are ways you can mitigate this, and we'll talk about that in a second. And 5, low gross margins. So how do you actually go big? This is where we get into some of the tips and tricks. It's not easy going after the big ideas because it's kind of obvious what the big ones are, and the incumbents are going after them as well. So my advice to you is a little bit of a paradox. Start small and start with things that don't scale. I always think of this image behind me, this seal on an ice floe circled by orcas and other big threats. Those are the incumbents, right? Those are the monsters in the market going after the opportunity that is really obvious. What you have to do as a startup is you're the seal. You're trying to find a nice little ice floe. It might be melting. You might outgrow it pretty quickly, but you find a little space, and then you hop to the next ice floe. And you eat a little bit more, and that ice floe kind of melts, and then you hop to the next one. You start out with something that doesn't scale, service maybe, or some sort of niche offering, and then you make that into a product that you can repeat. And then once you have a product that's repeatable, you figure out how to market it and how your messaging resonates, and you can really pour fuel on the fire and grow very quickly. Pretty soon, you end up as the orca. Now, this is very specific to OT security. I said you should start with a product that doesn't scale, but my number 2 point was we don't invest in products that don't scale. So how am I supposed to resolve that for you? Well, startups are really tough, so I don't have all the answers, but here's what I'll tell you. The margins on software are really great. The repeatability and control you get from deploying hardware is really great. And then the customer service you can provide and the solution you can offer with services is really great. So in pure software businesses in the B2C market, like an Uber or an Airbnb, it's great to be all software. And you can do what Reid Hoffman, founder of LinkedIn, calls blitz scaling. That doesn't really work as well in B2B. So you got to be thinking like strategists in the military. And you got to go with combined arms. So you want a little bit of software because you want scalability and you want your margins to be good. You want a little bit of hardware and a little bit of services. And anybody who's ever played a real-time strategy game will understand this. The spearmen can beat the cavalry can beat the archers, and the archers can beat the spearmen. So the best is to go with all 3 of them in your army together. Now, my fourth point was about credibility. And if you're early stage and you don't have any customers, it's really tricky to show an investor, that you're growing and you're credible. But there are a few ways you can do it. And it's a little trite, but nothing succeeds like success. So surround yourself with successful people. Surround yourself, more importantly, with people who want to see you win. Early stage, that may not be customers. It might look like advisors. It might be your co-founders. It might be employees. Eventually, it'll probably be investors. Investors do look at other investors and see whether they're credible in the space, whether they've had good investments in the past. And then ultimately, it is going to be your customers. But not all customers are created equal. The customers that are more transactional are not going to do as much for you as the ones who are helping you be a design partner, figure out the features, understand your market. So those are kind of my tips in general. And now I'm going to give a little bit of advice to each of the specific audiences here. For customers, you want to go really big. And that means you have to share your big problems with the startups. If you just share little problems that they can kind of pick at the edges, it's not going to be worth your time. You're really busy. You're trying to defend your networks. And it's not going to be worth their time. They're not going to end up with something that's investable. It's also important that you share your big problems with startups because you'll get more access. You'll be allowed to give input into the features. You'll be a design partner. You'll get the solution that you want instead of just getting something thrown over the fence to you and saying, well, buy it or don't. And then lastly, this is a big problem for a lot of corporates and large industry. They want to make sure the startup is going to be around for a long time. They want longevity. So they don't want to partner with a startup only to have it go under in a couple of years. So there are a couple things you can do. One, you can make sure that they have good financing, a lot of runway to survive. But more importantly, you can talk about it. And this is one thing I think customers can do a lot more of. You can do use cases. You can talk to your peers about it. If you love a startup and you talk about it, other companies are going to start being customers, and then that company is going to be around for the long haul. As an employee, you want to go big because you want to be on a rocket ship, right? That's the dream. You get options, this company IPOs, you make a lot of money too. But that means you got to think kind of like a venture capitalist when you're thinking about your career. You should be asking questions about whether this company can really scale. And then once you know whether this company can scale, you got to see whether it's the right fit for you. Are you bringing something to this team, and are you getting compensated in a way that lines up with their roadmap and their milestones so that you can help move the needle on hitting a milestone, and then you're getting compensated in terms of equity or options for moving the needle. And then finally, you don't want to be the 10th marketing person at a startup that doesn't have any software engineers. You want to be a differentiated person who can really add value to that startup's roadmap. So this is slightly different than being compensated for it. You want to make sure that your ability to help drive scale is unique to you. And then lastly, for the founders in the room. So the credibility question we talked about a little bit. It is about surrounding yourself with really great people and people who want to see you win. But it's also about listening to them. So we think the founders are really credible when they take that advice, they internalize it into their product. So it's not just about throwing up somebody's headshot on your website. It's about listening to them as a customer, as a person with a lot of experience in this space, and then having that knowledge and that experience speak through your product. The one point I didn't get to in the 5 reasons that a VC won't invest in an OT security startup is gross margins. And that's really tough. Nobody's going to help you out with that, right? Customers are not going to ask you to raise prices. So this is the responsibility of the founder. And the only reason that you can credibly go to a customer and say, I should be charging you more, is if you're providing even more value. So you have to be a product visionary. You have to set the bar very high for the value that you provide to your customers. And believe me, they have plenty of money. They're not going to complain about it if they get a lot of value out of the product. And then finally, this brings me to my last point with the founders, is product market fit. Product market fit is not some metric we're looking at in terms of average recurring revenue or making it into some Gartner Magic Quadrant. What we mean by product market fit is if we're hearing that the customers are pulling this product from you. So again, this goes back to being a product visionary. It goes back to listening to your customers, to your advisor, and to all the credible people that you've surrounded yourself with. That's all the tips and tricks I have. If you don't remember anything else, remember, go big. And if you'd love to talk to me afterwards, I can be reached at Robert Terrin or Rob Terrin at Twitter, Terrin at energyimpactpartners.com, or you can go to our content hub, hypervisor.vc. These are our various portfolio companies. If you want to get in touch with them, I'd love to put you in touch. Happy to talk about the process for investing in any of them, or if you'd like to be a customer, about the various offerings that they can provide. I think I have a couple minutes here to take any questions. Thanks for your time, and please ask away.
Hey, Rob, that was great. Thank you for demystifying some of the aspects around investment and in very clear, tangible examples. So you talked about going big, and you alluded to it. Can you say more about what are the questions that people should ask themselves to figure out if it's big enough? How do they push themselves out? And where do you find that balance between big, crazy, it just might work, impossible?
Yeah, it's a good question, and there's some heuristics, but there's probably no firm rule around that. Roughly speaking, for a company to be a viable IPO, initial public offering, where they sell stock to the general stock market, it needs to have a market cap of $1 billion. So depending on the way valuations are calculated, a rough rule of thumb is that you want 10 times your annual recurring revenue to be $1 billion company. So you should be doing 100 million in sales after 10 years. So if you think you can get to 100 million sales, then it's definitely a big enough idea. If you don't see a way that it's even possible to get there, I would say go bigger. If you're coming up with some crazy number where you back into the cybersecurity market for anyone who has a personal computer, and you say, there are this many billion personal computers out there in the world, and I'm going to sell my software to 1% of that, it's probably not very realistic, and I would reevaluate how you're coming to that market size. So rough rule of thumb is $1 billion, give or take.
With SaaS coming into our space, I was just curious about, looking at scale-ups and kind of the core, the service, software, balance, and, any other specific expectations around margin there.
Yeah, thank you. That's a good question. Some of these companies on the slide are more SaaS-based. Almost all of them have an on-prem solution because our investors are utilities, so they care a lot about having that as an option. But the SaaS margins are good. Certainly seen a lot of success in the general cybersecurity investing market. I think it's an and in the OT space. You have to have SaaS and something on-prem. For investor perspective, it's a really good sign because we can predictably tell what your revenue is going to be. The recurring revenue is really what we're interested in seeing, as opposed to one-off services deals. If you can transition those services or pair your services with a SaaS solution and help move them into the product and kind of take the services you're offering and build them in as a feature, that's a really positive sign. And I think a thing that a lot of venture capitalists look for as an inflection point in a company that maybe had a roll-up or came from a services background, but could potentially be a great outcome in the future.
Hi, thank you. I wanted to ask, in the past and up to this point, like you said, in OT, there has to be this on-prem version of the solution. But going forward, it looks like that will no longer be a regulation or a requirement. Mm-hmm. So how do you kind of see this changing once OT doesn't have that limitation anymore?
Yeah, in some ways, I agree with you that the air gap is dead, and we're seeing more and more cloud in the OT space. It's still single-digit penetration at this point. So I think there's a long time until, maybe never will you see, everything in the cloud and complete removal of on-prem. That said, it's growing, and it's growing fast, even if it's off a small base. So,
how would you consider things like artificial intelligence figuring into production and things like that, and the need to actually be able to connect the edge to the cloud to do the type of big data calculations that requires.
Yeah. Yeah, I think that's a really good point. There's a lot of security opportunity in rolling up that data in the OT environments, and then edge security, because all the compute and a lot of the models are going to be done in the cloud. With AI, it's always tricky. It depends what people mean by AI. We certainly see a lot of machine learning, predictive analytics, forecasting of what you're going to need in terms of load or demand response. So all of that AI, I think, is in the market today, and we've invested in a couple of those companies. It's hard not to be very commodified in AI unless you have a data set that is unique and proprietary that you can train it on. The models are, at this point at least, mostly open source. You can come up with your own model that nobody else has that's, head and shoulders above everyone else. I would say that would be a great breakthrough. But in general, I think the AI use cases will be more case specific. So we have a company called Urbint, for example, that looks at underground gas lines and helps you predict where you should do maintenance first. That sort of stuff, I think, is really useful. The artificial general intelligence stuff, I think we're still a long ways out from, but I'm optimistic. Great. Thank you so much.